making of the market. Ajay, hi, morning. Lots of consolidation, and I guess the market was just waiting to show us what it's been showing on the ticker for the last 2 days. It's already closing in on 25,500. Seems like a new high before Diwali, Ajay.
Good morning. Good morning. Yeah, I think so. I think, this any tax cut of the kind of a GST has done, it's a great signaling because money moves from the government to the people, which is a far more efficient way to run the economy. So I think it's a great positive. One has to see how much of the elasticity of demand which comes through what's happened in the last 1 month. We have postponed a lot of purchases. So cumulative impact will come through over slowly. But by and large, the optimism is that the mood in the government policy is towards more liberalization of taxes. And I think that's the important feature for the market. And number two is the realization that, consumer demand can't be ignored up to a point. And then you got to step in and stop that needless road expansion which was taking place and direct some of the money towards smart city, etc. All in all, I think the policy framework has changed. And as always, equity guys, we need to change with the policy framework. Market is strong, positive, flows are good, valuations are now stratospheric. So now you are in the true casino territory of equity investing.
Okay. So what are the short-term trades that the casino is throwing up, and what's looking attractive right now from a market standpoint?
See, capital market looks to be stronger. It got a big leg up in the last 1 year. It corrected quite rapidly and has come back again. So I think capital market participants will do well. I think there has been a lull in the infrastructure companies. They should do well now, given the fact the consolidation, the correction put together. Ps are still high, but I think they will get a lot of traction in the next 6 months because it's been neglected for a long time. And neglected sectors tend to bounce back faster. IT, perhaps confidence is misplaced in my view. That won't happen very much in the sense of, in terms of their own performance at this point of time. But domestically, auto, you've already seen, it's been a run up. Now it's going to go on to auto ancillaries. So all in all, I think any other sector which impacted by Aisha by the GST cut, particularly the auto, I think it's going to be a great beneficiary. We have a great auto industry. We are global leaders in that. So I think that's one industry as investors you can pick. And that I would say outside the casino. Casino is right now the small caps and the retail stocks and all running at 90, 100, 120 Ps. I think anything beyond 50 P or 60 P, I would put it in the category to say you must have a very good reason, apart from Newcom stocks, leave aside, you must have a very good reason why to be there. And there are a lot of stocks at 70, 80, 90 Ps. I think that's where the real roulette game is going on. There's going to be black or white. And I think that's where the problem will come is that when you buy a stock at 90, 70, 80 P, you really are trading very, very treacherously.
Right, Ajay. Hi, morning. This is Snehi also
Good
joining
morning.
in. Good morning. Now, the last time we interacted, Ajay, it was just days before the GST meeting. And now that the outcome has come out, we have absolute clarity on what reduces and what looks better. I remember you had said that you will not be adding anything to consumption on the back of this GST cut. Well, that may have been on staples. What's your take on the overall consumption? Could be discretionary, white goods, retail. Are you staying away from those two?
See, it's important to understand that GST cut lowers the price for everybody. Okay, it doesn't lower the competitive intensity in the market, which is quite high in Indian context. If you look at durable market, we are in a very high competitive zone, and you as any portfolio manager does or anyone does, you need to allocate your capital to where you feel most comfortable. In any sector where the competition is 10, 12, 14, 16, 20 companies competing for the same share. Now, GST applies to everybody. So everybody cuts the prices or supposed to cut the prices. So it doesn't relatively affect the competitive ability of one company to score over the others. Demand may go up. Let's see how much it goes up. I'm quite, it's not going to be like, it's going to jump up 30, 40%. People were buying and this affluent segment was buying on loans or whatever. So therefore, the segments where the competitive intensity is so high, we tend to stay away from it. We like sectors where you have got 2, 3 players with a clear moat to make returns over time. And therefore, one of the two of the competitive players may do well in 1 year. Somebody may take the lead in the second year. So the long-term portfolio, you tend to have a very, very kind of a risky profile of some of the segment, including consumer durables. That's why we keep away. And beauty is, India has given you so many new companies to invest in, new industries, new e-com companies, new segments, newer fresh blood coming in. So you don't really have to go back to the old bread and butter. If you look at the US market, where is the market cap? Not in the whirlpools of the world. The market cap sits in NVIDIAs of the world, which have come up in the last 10 years. And I think same applies to us. If we are going to invest in those industries which are dying globally as a market wealth creator, I think you'll be doing sub-allocation of your portfolio. So it's not about GST. It's just that the segment itself has lost traction in terms of value creation.
All right, but the other pocket, Ajay, that is doing very well of late is actually the banking space. Once again, a renewed interest. Help us understand what's your latest take on the banking space. And also with respect to the point that you were making on valuations, some experts too believe that they are not trading expensive.
Of course, it's not expensive. Banking industry is quite cheap. And, my views in the last so many interviews of yours has been less than this thing that if I have 100 rupees, the last segment I would allocate this to banking in India. And again, the same issue is that if banking has to do well, the economy has to do well. If economy does well, every other part of the economy would do much better than the banking relative to your portfolio, by and large. I think that's what's been true for 5 years, will remain true. Same logic applies competitive intensity. Please see the number of banks in India, the number of NBFCs who are competing for the zone space, the gold loan companies competing. And then you realize that how would a bank create alpha contribution to your portfolio? Short-term positioning, it may go up, some may go up, some may go down. But if you look at the large cap banks, they haven't given you value creation of any kind, including your inflation returns at this point of time. As an industry, it's so competitive with very less differentiation of products. Up to a point, you can say, okay, a bank is good here, a bank is good there. But the point is, they don't really offer anything undifferentiated. But you have, say, let's take an example, I'm not recommending it. You want to order food. There are 2 companies to order food from, maybe 3 in India. But if you want to go to banking, you have 20 choice of 20 banks. And at the end of the day, therefore, when you allocate your portfolio and you say banks, it's the most undifferentiated commodity business in the world today. Why would I want to put money with those industries which have no differentiation power? So yes, they look cheap, but so does a lot of good stuff looks cheap and they don't perform. If you look at your, cotton yarn companies in India, they're very cheap, but nobody buys them. You look at paper companies in India, dirt cheap, nobody buys them. You look at sugar companies in India, dirt cheap, nobody buys them for long term. So cheap is not the answer to your portfolio. The answer to your portfolio is growth and differentiation. Does your industry and companies have differentiation power to be generating returns? Look at what's happened to your investment if you've done it in telecom space. That's done phenomenally well over the last 5 years or 4 years because there are 2 players slugging it out and you make a return on it. It's a big moat. It's a differentiated product at the end of the day. So banking, nothing wrong with it, very cheap. But I would say if you have money, allocate to so many other companies in this country. For God's sake, why do you want to go invest in a bank which is not going to give you a return higher than the industry?
So what will then, Ajay? That's the question. Where is it that you have valuation comfort and growth visibility both? See, engineering sector in India, lots of good engineering companies, including a battery storage company. Some of them have been in railways. The Kavach story has turned out very well for most companies. That's done very well. The capital market stocks, they will have a consolidation phase, but they are doing tremendously well because as we grow, and as we open up the economy more and more, the traction goes up. Look at the market cap. Look at the number of new companies. Now, they will all start trading in the stock exchanges. There will be brokerages getting money. There will be depositories making money. I think capital market, engineering, auto, hospital, healthcare, I think these are 4 or 5 segments and which are great. And anything which is e-com, which is new, which you've probably been talking about for years, I think you got to be part of the story. And we have seen just now, a listing took place yesterday. I'm not saying it's overvalued, undervalued, but at the end of the day, can you imagine a world without these companies of yours 5 years down the line? You can imagine without 2 of the consumer durable players not giving you toasters. But can you imagine a world without food delivery companies, without the service delivery companies like Urban Company, etc.? You can't imagine that world. I think take your investment there, my friend. Forget the old. The old is gone. It's retired. Retire them from your portfolio as soon as you can.
I appreciate that view and, very interesting take on that front. But which are some sectors that could have or could see some renewed new interest? While we're talking about new age themes, which are some sectors of the past that you believe have been under pressure lately, but have more in store for them, or we could expect a run-up on that front?
I think, if you look at the past sectors, you could have a sectoral play coming up in commodities at this point of time. And that's a big one because the government has intent on policy to protect it. So you might find that the ferrous sector has a great traction, which has been the past favorites of many people, but come through. We could have a cement industry, which is an old fuddy-duddy, might give you extraordinary returns in the next 2 years or so, given the fact that the government might push for it and there's a regulation and so on and so forth. So, but I don't know how to answer a question because we really don't look at these companies by and large to have enough investment portfolio. We may be wrong. I'm sure about it. We are wrong in some places. But we are right about one thing, that you've got to invest where the future is. The future does not belong to a cement company, a steel company. Those are commodity companies. So, while you may say run up in the old companies may happen, somebody may catch up of time. But the fact remains, if you look at Nifty 50, look at the churn of the stocks taking place. Lots of companies are going out on Nifty 50. Look at the new ones entering. So therefore, I would still say that, I don't know how to say this, but the old companies, they will continue, but they will not give you alpha value generation at the end of the day. And your portfolios should be trying to do that at least if you're taking risk in the market. Otherwise, just go buy a REIT and you'll be fine with it. And I think that's a great place to be if you want a low return and safe and security. If you want to be in equity, then go for something which gives you a 20% plus target return. And those are companies with growth potential. And you just saw, people underestimate e-com. You just saw the results of Flipkart and Amazon. Both are unlisted. Hopefully they'll come to listing. Both are almost at the threshold of making profits at this point of time. So you can imagine e-com has turning and changing the course of this country. Go there, put your money if it's not there. Looks expensive. 3 years down the line, you'll be thankful you're there.
Absolutely, and those are great examples, Ajay. But I completely get that point, Ajay, that you gotta retire the old and you gotta be in these new age spaces. But there's got to be some part of the old which will also transition into the new, or for that matter, be an ancillary for the new. Do you not think banks or financials, NBFCs could be it?
Of course, but as I said, that the new participants are changing the name of the game in the financial sector. If you look at what's happening today, you're just having a threshold of a company called, which is about to list, Grow, okay, at the end of the day. It came up in the last 10 years. It's not a legacy company. It's nothing. And if you see the market share in SIPs, 40% market share of SIPs of that one single company. I'm not saying invest or don't invest, giving a fact that the newer players who are relying on newer technology in the same space are going to give you much bigger alpha return compared to the old banking system, which are sitting. Maybe they'll turn around one day. Maybe the elephant will dance one day. I'm sure they will dance one day at the end of the day. But the point still remains that for them to dance along with the youngsters who are far more agile, coming up with new technology, you are far better off. So where will you buy, let's take a Zerodha or a Grow or whatever is coming to the market. Where will you buy the shares? What happened there? You see it. Compared to, let's say, Motilal Oswal Financial Services or Anand Rathi or whatever. I'm not recommending giving names. Those have far exceeded your return matrices because they move with the market. You got in a big setup, like a bank, like HDFC Bank or ICICI Bank, it takes time for it to move. It takes time for it to move the needle for the shareholders. And therefore, I keep saying the fact that for a new company to move the needle is so much faster for your portfolio. Nothing wrong with the companies, but for them to move the needle is going to be very difficult. And you look at the large groups, Tata Group, for instance, as a whole, look, how do they move the needle for the investors? They just can't do it at the end of the day. So take your money to the places where the growth is, take the money with the places where you think you're going to get a return. And therefore, it's not about just retiring the old. For them, at the end of the day, Novak Djokovic could not do much at age 38. He lost to the two guys again and again. So just imagine your portfolio is like Novak Djokovic. If you got Novaks in your portfolio and don't have Alcaraz and Sinner, you know what's going to happen to it. They'll lose in the semifinals.
Well, couldn't have explained it better, I think. For all the young ones watching the show and wanting some stock strategies for their portfolios. But Ajay, always great chatting with you. Thank you for
Thank you very much. You have a wonderful day.
You too.